Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. The S&P 500 looking to build on 3 weeks of gains as investors prepare for a busy week of data. Tchir of Academy Securities writing this: I think we are near the end of the lower yields Fed put rally that has helped stocks creep higher on anemic volumes. Last week, we argued that the market might, quote, gap from no landing to some form of bumpy landing. Peter, I'm pleased to say, joins us right now. It seems like we're at some sort of precipice of narrative shift. Is that kind of how you see it?
Yeah, and I feel we kind of clung to this American exceptionalism too long. The data started turning a couple months ago. You've seen it in the City Economic Surprise Index, which encompasses a fair bit of data. And yet all you heard was American exceptionalism, American exceptionalism, American exceptionalism. I think that narrative has changed, and we're going to wake up one day and realize, whoa, things aren't as good as we thought they were. And I think that's where we're at right now. And Friday's consumer confidence was certainly a shock to anyone who thought everything's still rosy.
Well, this is the reason why some people are looking at this idea of maybe not Goldilocks, but a landing, which will at least bring the prospect of Fed rate cuts back on the table. Why do you see it as something more pernicious than that this weakness is maybe more entrenched?
One, we've all been asking for the last year and a half, when does the consumer slow down? When does credit card debt, all these things start impending, stopping their spending? I think we're seeing some of that. Again, what I found really striking about consumer confidence on Friday is University of Michigan publishes both by Democrats and those affiliated with Republican Party, and the Democrat Party side went down precipitously as well. It's down below 90. So that struck me. It's, there's this party as we're heading to the election. People seem very depressed on both sides. They're worried. I think that kind of accelerates. We'll get a lot of information about sales. And the big thing to me is equities have already had this Fed put rally. So I think we've priced in a lot of Fed put type narrative. We're not going to get that many cuts, even if they cut.
We were speaking to Cameron Dawson of New Edge earlier this morning, and she said she's actually more interested in retail sales than the CPI print, maybe because of what you're just talking about. Would you agree with that? Is that sort of how you view things?
Yeah, I think there's a decent chance CPI will come in lower than expected. Just all the way the calculations are done. We probably get a brief rally both on bonds and stocks on that. But it really comes down to what's going on with the retail, what's going on with consumption, what's going to happen, I think, with trade tariffs, right? If we're going to put on more tariffs on China, how do they respond? And I think we have just started this trade war, and it's accelerating. And what we're going to see is more and more margin pressure as Chinese brands try and compete both in China, but also across the globe, not necessarily in the U.S., but I think that's where there's going to be margin pressure. There's going to be competition with these Chinese brands. That's not yet priced in at all. And I think tariffs, if we announce this week, will make that more clear to people. Hey, we've got to be aware of this. And it's changing how the world global economy is behaving.
Well, I want to get to that in 1 second. This has been your thesis for a long time that's been really prescient, which is basically this is a glut of goods, and the Chinese government's going to try to flood the rest of the world with stuff that they're overproducing because they structurally have to, because their economy relies on it. It's sort of the new housing market is a new industrial overproduction. Before we get there, though, I want to just have you respond, because you seem in direct opposition to what HSBC's Max Kettner is saying. What he put out this morning, the dip in risk assets is increasingly in the rearview mirror as many major equity indices have reapproached their year-to-date highs, talking again about Goldilocks, that essentially some of these pressures that you're talking about are going to keep the Fed cutting on some sort of trajectory that will allow things to keep chugging along. Why do you think that is going to end at a time where earnings have come in stronger than people expected and companies are displaying a good deal of pricing power and been able to shrug off some of the geopolitical headwinds?
No, I think one big thing that's been helping the stock market is a huge record buyback. So we've seen record buybacks. That's certainly supporting stocks. When you look at it, right, in some of the past week, you saw a little bit of weakness, and then it was overcome during the course of the day with what looked like a lot like just, corporate buying. So I think that's been supportive. I think the valuation questions are still real. How much has AI driven us? Where are we headed on AI? Are we getting the benefit? all those things will start playing out, right? We get NVIDIA earnings next week, so that'll be an important part. So I think the valuations are creeping back high, setting people up for another disappointment, and that's why I think we dropped this 5 to 10%. We got down about 6%. We never got to that 10% level. I think we get there, in the next few weeks or months as this realization sets in. There's still too much hopium out there.
Well, this raises a prospect of what's the catalyst? Is it going to be economic data pointing to a more material slowdown in the consumer? Is the consumer maybe not as significant as people previously thought, which is something that we heard in an interview that Danny Berger did earlier this morning? Or is this really going to come from the geopolitics of the moment, of more tariffs, of widening pressures, of this question of whether companies can sell in China at a time where the gates are going up in the U.S.?
So my base case is that this economic weakness has been helping yields lower. That's been helping stocks. We're going to hit a point in the coming days or weeks where we see more economic weakness and people realize, wow, maybe this isn't so good for the future of the market. And that's when you start rolling over in stocks. And then you've got the geopolitical risk. You've got the made by China theory. You've got the tariffs. All of those things, I think, are almost quote unquote freebies if you're going to be short or underweight this market. I think any of those alone can knock this market down, and you potentially get multiple of those things occurring. So I think we're well set up if you want to be underweight to benefit from that. I still like yields. I think yields do go lower, but stocks are going to start giving up this whole narrative of lower yields is good for stocks and say yields are going lower because this economy is shaky, and maybe even jobs aren't anywhere close to as good as the published data has been.
How much do you see a potential rally in government debt, given some of the hangovers with inflation, given the fact that we are seeing tariffs being put in place, and given the fact that the deficit, which some people worry about, some people shrug off, is continuing to climb?
Yeah, I think at the front end, we should get to 2 cuts this year. Maybe you see price in 3 cuts. I don't think we can get any better than that. And on 10s, I think we can go down to maybe 430. So I kind of have this 430 to 450 range. But as you say, you've got all these other issues. And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago. And as you look through the data, you go back through, look, a lot of the ISM, a lot of the PMI, all prices paid were much higher while the rest of the data was weaker. So, I don't want to say stagflation. I don't think that's a realistic situation, but I can't dismiss it as easily now as I could a month ago.
Just real quick, which commodity? Because oil prices haven't been really shooting higher. What are you watching?
So copper's up quite significantly. You've seen gold, the precious metals up, nickel's up. A lot of the industrial metals are actually up. Oil's been fairly stable. Oil had a lot priced in, and it's kind of been calm. Again, it hasn't really retreated, even as you've seen kind of the status quo emerge in the Middle East. So I think that's still susceptible for a shock. But really, copper's been one of the big keys that I've been looking at.
And with a 5 to 10% decline in equities, Peter, are you a buyer? Is this a buy the dip moment?
Yeah, I think so. I think it'll be a good opportunity. Again, right now, I like foreign stocks better than U.S. stocks, so I'm not completely bearish on the global economy. I like Chinese stocks, Indian stocks, much better than I like, the NASDAQ 100. And I am wanting to buy banks and some of the things that have lagged behind. So some of these low valuation, high debt companies, I think they can rebound as you start getting through this. And we even started seeing in the past week or two, right, where some of the, the Russell 2000 has been doing a little bit better. So I think if we get that pullback, that's where I want to invest. I like the equal weighted indices better, but I am waiting for a pullback to get really committed.
Peter Tchir of Academy Securities, thank you. As always, really wonderful insights. Meanwhile, the Financial Times reporting that the New York Stock Exchange is surveying market participants on round-the-clock trading. The survey, coming as a startup backed by Stephen Cohen's Point72 Ventures Fund, is seeking SEC approval to launch the first round-the-clock exchange. Let's head to New York, where Danny Berger is joined by the New York Stock Exchange President Lynn Martin to talk about why we all need 24/7 trading in our lives. Danny.
Hi, Lisa. That's right, because, we want to be wrangling the kids and have the ability to trade while we do so. Hi, Lynn. Thank you so much for joining us.
Thanks for having me.
So some others might have opinions about this, but overall, the survey that you've gotten so far, from what you've heard, I know you're still in the middle of it. What have you heard?
So far, what we've heard is there are a lot of things to consider, mainly on the infrastructure side, which is not really a surprise. It's why we sought out to get feedback before something like this was introduced by the SRO community. We wanted to understand all of the pieces of the ecosystem that would need to fit together if we're going to introduce this responsibly. So the feedback so far hasn't really surprised us. There's a lot of parts of the value chain to consider.
So realistically, if you did want to do something like this, how long would it take to actually set up that type of infrastructure?
Well, there's a variety of things that would need to be considered. Most importantly, we would need to talk to our regulators about it, not just us. Our clearinghouse, DTC, would also need to consider that with the regulators to the extent that they would remain open for that 24-hour trading.
It's interesting because there does appear to be demand here. Lisa mentioned Steve Cohen's venture wants to do something like this. Do you have any sense of idea of where that demand is coming from, the type of person that wants to be trading 24/7?
So I don't know that it's really 24 hours a day. I think what has started most of the demand, what's really triggered most of the demand, has been the rise of the ETFs. And if you look at the basket in some of the ETFs, particularly the international ETFs, they're not just securities that are listed on a domestic exchange. So from a risk management standpoint, it would make sense that you would want to manage your risk in the underlying baskets when those domestic markets are open.
Fair enough. Now, Lynn, when it comes to IPOs, we started this year. You and many folks were excited for 2024, that it would be a big year. So many people's hopes have been dashed. I think the volume is somewhere still near a decade's low when it comes to IPO volume. Are you still hopeful for this year?
I absolutely am. And actually, I'm incredibly optimistic given the amount of proceeds that have been raised so far in the markets. $14 billion so far has been raised in the U.S. markets through last Friday. We've had about 25 operating company IPOs on the New York Stock Exchange. That's 2 times the amount of proceeds raised year to date versus last year and 3 times versus 2022. So the markets are definitely opening up. And what I'm personally excited about is those companies we've welcomed have not just gotten large deals done. Many times they have upsized their deals. They've priced either at the high end or above the range. And then they're seeing that pop, the 20% pop when their stock opens. So it's been a really exciting, particularly Q2, really exciting time where we're seeing about 2 IPOs a week at NYSE.
Well, Reddit is a great example of a company that IPO'd, a lot of fanfare around it, but a company like Reddit, it's a mature company. It's a quality company. Investors feel safe with it. Is there room for anything outside of that?
So you have seen some more growth-oriented companies go, but importantly, as you mentioned, they've had a path to profitability. So I think that's really what is getting valued. It's why those companies that either are profitable or have a path to profitability are getting rewarded. You look at a company like Viking, which is the largest IPO of the year. It's a household name. I had so many people say to me, I can't believe this company isn't public already, given that many of us have enjoyed their cruises, whatever the case may be. But then you've also got great companies, emerging companies around cyber, like Rubrik, who just IPO'd on us a couple of weeks ago.
Even with the uptick in demand, Preqin data came out that there's still $3 trillion of money tied up in aging companies that haven't gone public. There still is this impetus to stay private for longer. Are you concerned with, as companies stay private for longer, that they found alternative paths to going public and just that norm that we used to see, it's not going to get back to that?
I'm not really concerned because there is no match for the U.S. capital markets in terms of an efficient form of capital and attaining that capital that you really need to scale your business, not just from that perspective, but also rewarding employees, democratizing investment, M&A. M&A is a big reason that I hear some of these companies going. They believe that there's a different M&A currency that you get with becoming a public company versus staying private. So I continue to be incredibly optimistic. However, if people are going to be more thoughtful about when they go public. I don't think you're going to see a rush to the public markets like you saw in 2021 for quite some time. But importantly, I think we're out of the 2022, 2023 closed IPO markets.
Is there a chance we get back to that rush, and what needs to be in place for that to happen?
Well, it feels like, we have the capacity to have a pretty normal year. If we've raised just over 14 billion to date, in an average year, you raise about 45 billion in the public markets. We're not too far off. And based on what we're seeing in our pipeline, I think this could be a pretty close to normal year.
How much of that depends on the Fed cutting? Is that necessary?
I don't think it's necessarily dependent on the Fed cutting. I think people are getting used to this concept of there's a little bit of uncertainty in the markets. The big concern you had over the last 2 years was the hard landing versus soft landing, and I think people feel pretty good about our economy. So I don't know that it matters if the Fed cuts once, not at all, whatever the case may be. But I do think you'll probably see a little bit of a closure of the IPO markets around election time, like you have in any other election year.
Fair enough. And going back to some of the things you mentioned of why the American IPO market remains strong despite some of the wobbles, things like the liquidity, the investor base. It's made it a global destination. But there was this report that Shein, the Chinese fast fashion company, wants to list in London instead of the U.S. because of the regulatory environment. Is that global beacon that the U.S. going to change with the U.S. regulators that are more intent on cracking down in China?
I don't know about that. I mean, I can't really speak to the conversations that a prospect like a Shein has had with our regulators. I do hope that they're able to enter the U.S. markets, but it will be up to our regulators to determine how.
Okay, Lynn, we're going to have to leave it there. Thank you so much for joining. Really great to see you. That is Lynn Martin of the NYSE. Lisa, with that, I'll send it back to you.
Right now, with us here in D.C., we have Torsten Slok, Chief Economist for Apollo, who is here for the same event that I'm here for. So I'm very glad to see you. I want to start with a question we've been asking all morning, which is more important, the inflation data or the retail sales data?
Well, if you view it from the Fed's dual mandate, which is inflation at 2% and full employment, inflation is probably a little bit more important. And particularly it's important because for the last 3 months, we've seen the annualized change in supercore go up by 8%. We've seen the annualized change in core inflation go up by 4%. So the momentum in inflation in the last 3-4 months has just been moving in the wrong direction. So what's really important about Wednesday's number is whether that momentum continues or whether we're going to see indeed, as Mike and Danny was just talking about, move lower in inflation.
Why do you think from the Fed's reaction function they care more about that CPI print, which a lot of people, including Austin Goolsbee, have said is a lagging indicator, versus a real weakening in the consumer in a sense that growth is being challenged?
Well, I think the problem for them is that the momentum in inflation has just not been going down for the last several months. And if momentum has been building to the upside, we really need, from a Fed perspective, to see that momentum break. And that's the risk with the numbers this week. Shelter, there's an argument about, well, on the one hand, maybe areas of occupancy rates are looking a bit better, which would argue for shelter inflation to come down. On the other hand, Case-Shiller is now rising at 6-7% at an annual rate. So that means that we're seeing momentum actually building in home prices. So there's different parts of the scale here that are weighing on. We just don't quite know what the shelter inflation data will do. And it has been coming down a lot slower than what anyone expected. And that might still, combined with auto insurance and combined with everything that's going on in the subcomponents, still continue to put some upward pressure on inflation.
So you still see no rate cuts this year?
We still see no rate cuts. And of course, now FOMC members are also beginning to talk about no rate cuts this year. So I do think that it's just becoming more and more difficult. If you put it together in a little spreadsheet, the growth rate that we've seen for the last 30 years for the rest of this year, you will still have inflation at around 3% by the end of the year. You need a really dramatic slowdown in inflation, 0.1 for every single month for the rest of the year to get core PCE inflation back to 2% by the end of the year. So the upward pressure on inflation is just really strong over the next several months.
What we heard from Fed Chair Jay Powell a couple of weeks ago is a real indication he wants to cut rates. He is concerned about the strength of the economy. There is clear deterioration there. It seems like the bias has been more on strength than potentially that inflation read. What makes you think that's going to change, given the fact that we do see real pressure that's coming through with initial jobless claims, with consumer confidence, with the fact that people definitely are feeling something that's coming through in the numbers?
Oh, absolutely. And that's why to retail sales, it is also important. It's not that inflation is the only important indicator this week. Retail sales does play a role. What is interesting is if you look at the Bank of America card data, both for debit card and credit cards, it actually showed, surprisingly, where they show across the income distribution, that there was actually a fairly significant bump higher in spending for both the low income, middle income and high income groups in the month of April. So there's a number of different indicators that are pointing in different directions. We do see, to your point, delinquency rates go up, in particular for low income households that are younger on auto loans and credit cards, and student loans also have been seeing some pressure. But the bottom line still is that let's see what the data gives us, because overall, yes, the latest non-farm payrolls was a little bit weaker. There were two reasons why that was slightly weaker, but the conclusion still is this economy is not falling apart. It is still a fairly solid growth rate that we see over the next several quarters.
We've been talking about the flip-flopping narrative. We had no landing for a lot of this year. It's been flipping and flopping depending on the day, sometimes in the same day. Then we got to Goldilocks, and that seemed to be where everybody was at for about a couple weeks. And then now people are talking about the potential for a hard landing due to economic weakness. It sounds like you don't disagree. It's just later than people expect, and it's not soon enough to keep the Fed from holding rates where they are. Is that correct?
I think that is correct, but I think that the tailwinds to the economy that are still behind us, two things, namely, we still have behind us a very strong tailwind that comes from easy financial conditions. The stock market is up $9 trillion since the November 1 FOMC meeting when the Fed began to talk about rate cuts instead of rate hikes. And on top of that, we also have a tailwind from fiscal spending. We still have strong spending in the pipeline from the CHIPS Act, Inflation Reduction Act, the Infrastructure Act. Those two things, easy financial conditions and easy fiscal policy, which, by the way, is very different from what's going on in Europe, but those things are likely to continue to give us fairly robust data, at least for the next several months, and most likely even all the way through the end of this year.
Stifel just put out commentary that seemed to agree with what we heard from Peter Tchir of Academy Securities earlier. They said the next 500 points for the S&P 500 are going to be down, talking about a 10% correction, similar to what we heard from Peter. Why do you disagree that there is enough ammunition for things to kind of hang in there and even creep higher, even as people really do wake up to real risks that we're seeing with respect to spending?
Well, I think this is a really important question. So the risk from higher for longer is two things. Higher for longer on its own means higher debt servicing costs for companies. That should argue for stocks going down and credit spreads widening. The problem is that the reason for higher for longer is that the economy is good, meaning earnings are good, GDP has been strong. So as a result of that, we should expect stocks to go up. We should expect spreads to tighten. So there's a tug of war between rates higher for longer is hurting, so to speak, in the CFO's office when debt servicing costs are having a negative impact. But if that's happening because the economy is good, I would still expect the economy to do just fine for the next several quarters as a result of the tailwind of the stock market going up, easy financial conditions, tight credit spreads, and also fiscal policies still providing quite a tailwind.
Does that mean that there's going to be a bigger downside on the other side?
That does mean that when we look into 2025, I do think that we'll set ourselves up, because think about the following, exactly as you're saying, Lisa. The fact that we have delinquency rates going up on credit cards and auto loans, even in an economy where everyone has a job, the fact that you have highly levered companies in venture capital, in tech, in growth, enterprise software that are highly indebted and experiencing a lot of problems, that these problems are still here, even in a good economy. That tells you once people do begin to lose their jobs, once the economy does begin to slow down, you already have a lot of distress, including in commercial real estate. There's a lot of office problems, obviously. Imagine what the problems will look like if you finally get the unemployment rate to move higher. So therefore, the sensitivity next year is that we might actually get a risk of a harder landing coming back. But that's not the theme for the next several quarters.
Meanwhile, you keep mentioning the fiscal overhang and how much that's going to be funding things. It is the reason why we're here. We're going to be speaking on a panel talking about the fiscal debt and how much that's really going to be a problem at a time where Steve Eisman came on and said, the deficit people have been worrying for the past 30 years and they've been wrong and wrong and wrong. Why is it different this time? Well,
because all the literature and all the papers that look at financial crisis and debt crisis, they do show that if you eventually keep on growing your debt levels up, and they just keep rising, and the CBO, the Congressional Budget Office forecast is that we basically go from 100% of GDP debt levels to 200% of GDP debt levels. Ultimately, it does try to stress the system more in terms of three things. things: what's happening in treasury auctions, what's happening to ratings, meaning sovereign ratings, and what's happening to the term premium. So that's why in financial markets we should be watching auctions, which we do every week. We should be watching what's happening from the rating agencies. Will we get another sovereign downgrade of the U.S. from some of them? Moody's still has AAA. Fitch has been downgrading in August. So that's really important. And the third thing is the term premium, which you can find on your Bloomberg screen here, has also been trending high in the last 6-9 months. So the stresses are slowly beginning to emerge. So far, most auctions are going fine, but investors should absolutely be keeping an eye on this. This is something that's just a bigger and bigger risk in the background.
You have some incredible statistics in terms of the amount of debt that's going to mature by the government, $8.9 trillion over the next year. You talk about an average 12% of government spending is currently comprised of debt servicing payments. And we're talking about a lot of people who are still dismissing this in terms of a major risk. What do you think could be the catalyst? At what point do you say to people, you know, you can dismiss it until you can't? Is the election something you're watching?
Well, I would say that if you think about this from a corporate perspective, when debt levels go up, for a long time, it doesn't matter in most cases, and certainly it does matter. So the fear you can have, exactly as you're highlighting, that the rollover of existing debt is roughly around 9 trillion. Then on top of that, the budget deficit in very round numbers is about $1 trillion for the next many years. So that brings us to 10 trillion. And then, by the way, the Fed is still doing QT, which adds a few more $100 billion. So it brings you to more than $10 trillion that needs to be refinanced in the next 12 months. So that's roughly a third of GDP. If we do continue to see more spending, and if we continue to see budget deficits as far as the CBO continues to forecast, then I do think that investors need to watch very carefully what's going on again with auctions, what's going on with rating agencies, are they downgrading the U.S., and finally what's going on with the term premium, because that's where the stresses in financial markets will first begin to show up.
So put you down as or the deficit, one of those in that camp.
Absolutely.
Torsten Slok of Apollo, thank you so much.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.